credit. I know I've talked a lot over the years about financial institutions and savings and different types of debt and so on and so forth. And I realized as I was preparing to do an episode specifically on predatory lending that I've never done one just on credit itself. So I kind of wanted to go through and talk about credit. Um, the first credit card in history, in the United States at least, was in 1950, and it was called the Diners Club card. And this literally happened because the guy was at dinner and he forgot his wallet and decided that this would be a way to be able to not have your money with you, but then be able to still afford to do things and then you pay it later. Um, since then, it's blossomed into a very everyday use item, but it's really not that old in the grand scheme of the world. Um, Speaking of things that are not that old, we just last year hit our 50-year anniversary of women being allowed to access and have credit cards without getting permission. And this was all part of the Equal Credit Opportunity Act, for also doing things like buying homes. I found this really cool timeline that that shows the history of credit cards only through 2015. So there's some things that have happened since then. But if you're looking at this timeline, we see the very first American Express showed up as a competitor to the US Postal Service, which was really cool. And then it shifted into credit and into revolving accounts. Actually, it's not a revolving account. It is a charge account. Um, as credit cards decided to start becoming a thing. So we had situations where you could run a tab, like at a general store or at a bar, all the way into the 1800s. And probably prior to that, it's just what's showing on this particular timeline. And then we had store cards showing up in the early 1900s. And then this 1950s mark is where the Diners Club charge card came from. And shortly thereafter, only 8 years, the Visa was founded and American Express launched their first charge card. The difference between a charge card and a credit card is a charge card is someplace where you can charge typically however much you want to, but it's due the very next month in full, versus a credit card where you have a limit and you have to pay just a certain amount of that limit and you're charged interest on the rest of it. Um, so that's the difference between your charge card and your credit card. Then we start seeing advances in technology. For example, IBM created that magnetic strip that we've used forever on our cards, right? Then we see things like MasterCard coming in. And then we have the very first piece of legislature involved in this, which is called the Truth in Lending Act. And I'll get more into that later in the episode. And then we also see the Fair Credit Reporting Act, and we see the Fair Opportunity Act, Fair Debt Collection Practices. There was a lot of legislature that happened in the 70s revolving around credit cards and collections and things of that nature. Um, Discover wasn't actually founded until 1985, and it was actually a subsidiary of Sears, which I thought was pretty cool. Then we start seeing people using credit, which I did, and I linked the episodes to this one where I talked about some of the things like using debt. You see, Google was funded on a credit card. And then we also saw this for Guitar Hero and then Cheapo Air. And so several very large companies that we know were funded based with credit card debt, which is a very cool way to utilize credit to your advantage. From there, we start seeing identity theft happening, large breaches, TJ Maxx. We've got Target in here. We've got Home Depot in here. So you start seeing these very large data breaches and identity theft that comes along with it. Where we then needed, and this is all in the mid 2010s, where we now need to start thinking of security issues. And then we get into things like Apple becoming the first mobile technology for payments in 2014. Like I said, this stops in 2015, but the point of this is just to kind of give you a timeline of how very quickly things have happened um, within the history of credit cards. So when we're looking at credit, we look at two different things. We look at debt and we look at credit. Credit is typically short term and it's expenses versus debt, where we're looking at long term and we consider those assets like home purchases and car purchases. So, kinds of debts. I already told you revolving debt, that's credit card versus charge card. So we got credit card and then a charge card where you have to pay the whole balance off. We also have installments, which are things like um, auto loans and home loans and student loans, things of that nature, where we pay a certain amount every single month with the goal of eventually paying it off and no longer having that as an option. Personal loans are something that you can either get from a bank. The biggest thing with that is that there's no collateral involved, versus, or you could potentially get that from a friend or family member, but then there's a whole other host of things where I talk about contracts that you want to have when you get a personal loan from someone. So the cost of credit is really the idea based around our credit scores, right? So the lower our credit score is, that tells a lender, a credit card company, whatever we're trying to get of other people's money, that we may be a riskier borrower, and therefore we both have lower credit or fewer credit sources and higher interest rates, which is the amount we pay to borrow someone else's money. So we, but that is, they do that because there is data to back up that the person who has a $500 credit score is going to have a um, more likely to either not pay their bill on time or not pay their bill at all. Versus someone who has, say, an 800 credit score. Not saying that the 800 credit score is perfect, it's just that they are typically more likely to pay. So that's why people put so much basis on what your credit score looks like. And based on that credit score, it helps the creditor or the lender decide if they're going to give you credit. If so, how much are they going to give you, and what are they going to charge you in the form of interest to give you that? So, like I said, I was talking about credit score ranges. We range from 300 to 850. You can have a zero credit score, and that just means that you don't have any credit yet, which is just as detrimental as having a poor credit score. If you were a follower of Dave Ramsey, then of course he calls this a debt score. But and I've talked a lot about that throughout the episodes of the podcast. The biggest thing here is I want people to be aware that they can use credit, how credit is determined, and then you get to make that personal choice as to whether or not utilizing credit and having a credit score is the right thing for you. Okay, so what determines your score is really about payment history. Are you making these payments on time? How much do you owe? And that really is based as a percent of total debt available. So if you have $1,000 of credit card room, they don't like that you've maxed it out because you don't have any room to add more. It appears as though you haven't managed your money well, things like that. Versus being able to say have $200 or $300 on that credit card, that shows that you can manage with a small amount of debt on the card. You're making your payments, so on and so forth. Um, you do pay interest on the amount of debt that you have available or that you've utilized. So there is a cost to using credit, but it can get you into things like homes and cars and stuff that you may have as goals for larger purchases in the future. Length of credit history, typically the longer you have credit history, so the longer you've been an adult, that helps your score a bit. New credit, you occasionally want to be opening a new credit um, account. But again, if you open them too often, then that can also reduce your score. Anytime we open a new credit account, it reduces our score, whether it's a home loan or whether it's a credit card or store card or care credit to be able to pay off a medical bill. It opens the amount of credit that you have available to you and therefore puts a small amount of risk to everybody that you may be overextending yourself and then you're not going to pay anybody back. So it will reduce your score temporarily and then can increase it as long as payments are made on time. And then types of credits. They don't want to see just credit card payments or just credit cards. They might want to see a auto loan or a home loan. So you have installment loans, you have revolving debt, and the more types of credit that you're managing, the more the higher your credit score will be. However, notice that the new credit and the types of credit and length of history only make up 25% of it. The largest pieces here are your payment history, making every payment on time, and then also the amount owed into managing that amount for you are going to be the largest. So this is just a quick example of three people taking out $30,000 on a 5-year auto loan. And we look at the amount of credit they have, and therefore that translates to the amount that they're going to pay to have this credit, which is interest. And the question becomes, who's going to pay more? And it's typically going to be the person with the worst credit score because they are either going to have a higher interest rate or have a longer loan or both. In this case, all the loans are the same length, but they have higher interest rates. And when you have such huge discrepancy there, you pay more to utilize someone else's money. So, how do you find out what your credit score is? You can look at your annual credit report, go to annualcreditreport.com. The three companies, Experian, TransUnion, and Equifax, are required to give you a report, not necessarily a score, but a report once annually. You want to look at all three of these because not every company you use will report to all three companies. And if they report to all three companies or not, you still need to make sure that they've reported the correct information. Did they report that you settled your debt when you actually paid it off? Because that makes the difference. Did they report someone else's credit event on your credit report? Did they report that you filed for bankruptcy when you didn't? Is someone else using your credit and you didn't realize that? So it is your right to double check and make sure that all of your credit reports are error free once a year. So knowing your credit score is important because you know the cost of credit. If you know you have a lower credit score, you know you're going to pay more in credit. So, or in interest. So you then get to choose, um, are you going to be willing to pay more, or are you okay having a lower credit score and just paying cash for things? Um, are you willing to pay a little bit more to increase your credit score so you can get lower interest rates on things? These are personal decisions that you have to decide how you're going to work through those. This will also help you know your ability to get more credit. If you're maxed out on all your credit cards, first you probably want to work on becoming more debt free or lower debt. But secondly, you could pretty well tell with certainty that if you applied for a new type of credit, you either wouldn't get the credit at all, and it's going to report to your credit, or it's going to give you a lower amount than what you're looking for, or it is going to cost you more in interest. So knowing that helps you make those decisions for the longevity of your score. It will help you decide how your steps forward will affect your credit score. So if you decide you're going to start doing a debt snowball, you need to know where your credit score sits now. So as you start paying off your debt, you can see where your credit is going. And then it also is going to alert you to identity theft or credit issues. If, for example, your credit score is a 650 and then all of a sudden it drops to 600 and you haven't done anything different, that's a red flag. Something happened, and you need to go figure out what happened. Did something get reported wrong, or is there an identity theft issue? Something happened. So knowing your credit score will help you figure that out as well. So, very briefly, I want to talk about identity theft. Financial identity theft only makes up about 17% of all the different types of identity theft because we look at criminal character fraud, we can look at medical fraud, we can look at identity theft, financial fraud. Like, there's a bunch of different types. So, financial identity theft is specifically talking about people taking your information to either open new accounts in your name or taking your credit cards and credit card numbers and buying things on those. Both of those are considered financial identity theft. To protect yourself from such things, be very careful about how and when you're giving out personal information. Have fraud alerts open, know what your credit score is, like I just talked about in the last slide. And then also you can do what's called a credit freeze through the credit reporting bureaus. So you can tell them, I don't want anybody touching my credit, including me. And then to be able to pull a credit score, you have to go unfreeze it. So it's a more of a process. So it slows you down a little bit and makes you think, okay, should I really be trying to get this new credit card or something like that? And then having identity theft monitoring and restoration. I of course, we know some of the life locks and things like that. Legal Shield is a great one. It's called ID Shield because they do the restoration portion for you as well. It's very time consuming and can be expensive to try and do this yourself. So having a company that does the restoration for you is a great choice. Okay, so utilizing a credit card. Some people use it for cash management. They can use it within the grace periods. So, say they get a new credit card, they have 18 months to pay off the amount that's on that credit card without being charged interest. If you were very good at money management, but say you needed to pay for an emergency and you didn't have your emergency fund and you put it on a credit card, having something within a grace period might be a good way to make sure that you reduce the amount you pay in interest and you are capable of just paying off that principal. You can do this also if you have more than one card, you can do balance transfers. And then reducing risk under cash management is really about, do you take a credit card with you when you travel or do you take your debit card with you? Credit cards are easier and quicker to stop before they drain a lot of your personal money, which can be very hard to get back. The problem with having credit cards is it's very easy to impulse buy and interest rates. Right now, some of those credit card interest rates are nearing 30%. So many of them are variable. So as costs go up, they increase your interest rate. Now you're paying 30% on something that may have been an impulse buy, and it's very expensive and hard to get out of, and it's not something that you need to be doing in general. So, utilizing a credit card can be very problematic too, which is why you see many people like Dave Ramsey say, hey, just don't have them, which is completely a personal choice, in my opinion. But if you are going to have one, you have to be epically good at managing money. So when you're choosing a credit card, look at things that are important to you. Um, the costs include annual fees. Sometimes some cards just charge an annual fee just because you have it. Late fees if you are late making your payments, and then APR, which is your annual percentage rate. That can be very, very expensive, especially when you're looking at things like Discover and Capital One and Chase Visa cards right now. They're all right under 30%. That's really expensive. Um, Going towards between 2 and 3% interest on however much you have per month in your costs of owning said credit card. But you can also look at the features like grace periods, like purchase guarantees, liability, lines of credit, being able to pull money off of that card. So sometimes the features can outweigh the benefits for some people, and then consumer rewards. That's typically where people look at these, like miles points, or cashback points, things like that. So you'll see someone who has, say, a Capital One Venture card and they get miles points. The answer to anything like that, if you're going to use it, in my opinion, is to immediately pay off the card so you can capture the points, but then you're not stuck paying a bunch of interest, which would have made it just as easy for you to have bought the tickets outright instead of the cost of interest to get those points in the first place. When you have credit problems, the best thing to do is to be proactive. Don't be sent to collections before you contact a creditor. Call them, say, hey, I don't have enough money to pay this month. Work on negotiation, something like that, to be able to show that you're trying. A creditor is sometimes more likely to not put you into collections if you have had that uh, conversation with them ahead of time. Then use something like a nonprofit credit counselor. So this can be a financial advisor. This can be someone like me, which is a financial educator. This can be a Dave Ramsey mentor. So, this can be someone at your bank, like someone who's not going to be charging you for access to credit counseling. And same thing with credit, with debt consolidation. Um, be very careful because there are scams in both of those locations that can cost you more money and then they're not super helpful. If you are sent to collections, make sure that you understand your rights in the Fair Debt Collecting Practices. Some of your rights include not being woken up in the middle of the night from creditors. They're only allowed to call you certain hours of the day and certain number of times per day or per week. And then so look at the Fair Debt Collection Practices, and I have those in my show notes, a link to that, to make sure that you're within your legal rights. They can't harass you, they can't berate you, they can't call your friends, they can't call your family and try and get money out of you that way. That's all part of that Fair Debt Collection Practices Act. And then you can settle debt. Well, it's not the best for your credit score. Sometimes you can say have $5,000 in debt and they'll take three. Sometimes that's the best choice for you, especially if you're sinking and you're kind of underwater with your ability to pay off said debt. After being proactive and being sent to collections is exhausted, then you can look at something like bankruptcy. Unfortunately, with bankruptcy, it doesn't get rid of all your debts. It doesn't get rid of student loan debts. And there is current legislation attempting to be passed to where it doesn't get rid of medical debt either. So be very mindful if it's actually going to help you, depending on the type of debt that you have. All three of these may negatively affect your credit score, but being proactive will do it the least. Sending collections will be a little bit more, bankruptcy will be a little bit more, but time heals all. All of this will end up dropping off of a credit score with enough time. So this is just a quick slide. If you are listening to this, you can ask for these slides under my free documents when you sign up to be a patron on Patreon. But if you are looking at this on YouTube, this is a slide showing typical payday interest loans in the United States. And this is just examples of predatory lending, which I will be doing a future podcast episode on predatory lending specifically. So there's several laws, like I showed you in the history. We have come up here that um, allows you and your rights as a consumer within these laws to work and function. So we have, first and foremost, the Fair Credit Reporting Act. This allows for consumer privacy, accuracy, fairness, and rights. So this is the one that allows you from 1970 to make sure that your credit report is accurate and that you can see that once a year. We have the Fair and Accurate Credit Transaction Act, or the FACT Act. This is also going to be looking adding to IDT, so identity theft protection and prevention, credit scoring. This tells you when you've been denied for something, why they denied you. It also forces fraud alerts and gives you the option for consumer disputes. And then we have the Consumer Financial Protection Bureau. These are just some of the laws that exist. This is one that also came about in 2011, looking at fairness, transparency, and then competition and protection within the credit lending industry. These are other episodes where I have talked about credit or about debt in some way or another. Most recently, interest. I talked a ton about interest. How do you calculate interest? What goes on? So on and so forth. I did a multi-part series on the types of debt that can be used and then utilizing that debt to your advantage, especially if you're a business owner. In episode 55, I talked about financial institutions specifically and what you have as rights within this. This came about during the Silicon Valley Bank closing that happened. And then also episode 11, where I just talked about different types of savings. So please go back through that catalog if you haven't listened to these, and then share with your friends if you find interest in them. These are our personal or our references to some of the places where I found information. And I will link that in the show notes. Thank you for listening. Today we're going to talk about um, we've got okay